Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world that focuses on the wall of worry and is full of the pundits of pessimism. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So it's hard to believe today is December the 20th. It's hard to believe that 2022 is almost in the record books. And it's also hard to believe that we're nearly 3 years from finding out about COVID. And what a wild, wild ride that it's been. So last week, a lot of economic data was released along with the Federal Reserve's two-day meeting on Tuesday and Wednesday. And the negative reaction on Wall Street shows that the market seemed to have just a little bit of indigestion as it was digesting the information that came through. So what I thought I would do is just take a look at the 5 data points that were released last week and see what they could mean for both the markets and the economy. Let's begin by talking about inflation. So November's consumer price index inflation number came in below expectations, indicating that inflation is continuing to ease, albeit slower than we'd all like to see. But the good news is that at least inflation is beginning to come back down. And despite that, inflation is still well above the Fed's 2% goal. But we are beginning to see some relief in areas like cars, clothing, and even toys, just in time for the holidays. Let's talk about the Fed's decision last Wednesday. So as expected, the Fed raised interest rates by 0.5% for December, bringing the Fed funds rate to about 4.5%. Now, that fact didn't upset the markets. As a matter of fact, most economists were expecting that. But what did was the indication from the Fed that they see that the peak Fed funds rate will finish out somewhere around 5.1%, which was a bit higher than what we had all expected. Now, an important thing to note is that historically, the 12 months after follow the peak in the Fed funds rate can be positive for both stock and bond markets. So hopefully, brighter skies ahead. So while the Fed has been fairly clear about not cutting interest rates, right now they seem to have their foot on the brakes of the economy, not necessarily wanting to put gasoline back in the tank. And they certainly have indicated that for 2023. The market seemed to assume that those cuts would happen towards the end of next year. And they think that because of encouraging inflation data. In fact, if inflation does continue to ease and the economy should weaken, then we fully expect that rate cuts could happen, or at least need to happen sooner than 2024. Now, it's not just the US that's raising interest rates. Across the globe, central banks followed the Fed's decision by raising their own interest rates by 0.5%. And they continue to indicate that same hike and pause policy that we're seeing from the Fed. While we do expect economies across the globe to continue to slow for some time, data indicates that the US economy may fare better than its European counterparts. Let's talk about retail sales and consumer confidence, because those numbers came in lower than we were expecting in November. While this can be upsetting, particularly for the markets during the height of the holiday shopping season, it most likely is a result of a lag in the impact from previous action that the Fed has taken earlier this year. It's important to understand that even though 1 month's worth of data does not certainly start a trend, the slowing in consumer demand is definitely in line with what most economists believe, and that is that we will most likely see a recession sometime in the first half or sometime in the third quarter of next year. As you all well know, long-term investors, we've seen market and economic conditions like this, and probably worse, time and time again, only to come out on the other side positive, with positive returns and a growing economy again. In fact, there's a name for it: the economic and market cycle. And while it's not as predictable as the holidays, history does show us that conditions like this are fairly common, and that this too shall pass. That being said, we wish all of you a wonderful couple weeks. We hope that you're able to spend it with your loved ones, both family and friends. And if you're traveling, please travel safe. we certainly are looking forward to a happy and a healthy 2023. Have a wonderful day.